The UK government has announced independent regulation across English football. In this video, we'll review what that means, asking specific questions, such as what is the regulator and how has it come about? How will the regulator be funded? And what will the cost be to clubs? What guarantees can the regulator put in place over future financial failures in the football industry and breakaway leagues? We'll be looking at this from a club's perspective, leveraging our own experience, and making some suggestions along the way as to what can be improved with or without the regulator to help the financial sustainability of football. And this week's video will be a two-parter, so make sure you join us next week for the second half of this video. My name's Neil Wood and I'm a football finance professional. If you like the video, make sure you hit like and subscribe to make sure you don't miss any future videos of this type. At Football Finance Professionals, we use football to explain finance concepts for your benefit. We leverage our own experience and knowledge at the highest level of the game. So let's get into the independent football regulator across English football. On the back of the UK government's white paper, it's been suggested following the fan-led review by Tracy Crouch and her team that an independent regulator will sit over English football. This has come about on the back of COVID-19, which threatened the future of the game, and on the back of the European Super League, a breakaway league, a closed shop, one that would take the elite clubs across Europe and guarantee their future financial and on-pitch success, leaving the rest of Europe behind. And throughout the time that the Premier League was threatened with 6 clubs potentially breaking away, it asked the UK government for help, and as a result, the regulator has stepped in. The fan-led review was also as a result of several financial failures across the industry of English football, some more high profile than others, and some that could have been prevented, at least in the view of the government, if football was able to regulate itself. Following on from the fan-led review, initially the aim for the regulator was to regulate football both from a club sustainability perspective and a competitive balance point of view. The regulator now has 3 primary purposes. Number 1, club sustainability, followed by number 2, systemic stability, and 3, cultural heritage. Addressing competitive balance will not be part of the regulator's job, and having read the white paper, it's very clear that the regulator's primary focus will be around financial sustainability, securing the long-term future of the game. Any rules set out by the regulator will sit alongside the current set of rules that are defined by each league in English football, as well as European football set by UEFA. But what does club sustainability mean, and how can we guarantee the future of our clubs? In our view, it needs to centre around cash. Cash flow must be maintained in a positive manner, with cash flowing into the club from one source or another. Financial fair play has been around now for over a decade, and it's evolved since its inception. But what financial fair play has done is to generally create a reliance on club owners. And that's absolutely fine when club owners are willing and able to put money into their clubs. But if they decide that enough's enough, they can't afford it, and decide that now's the right time to walk away, clubs could potentially have liabilities, some of which may not be recognised on the balance sheet, that could trigger in future, and the next owner may not be able to cope with that cash outflow. If we think about business for just a second and put football to one side, limited companies, which are the vast majority of legal entities in the football space, are separate from their shareholders. Limited companies are designed by definition to go beyond their founders. Their reputations, their brand, their ability to trade should be separate to that of their shareholders and owners. And with a dependency on another body, whether that's a shareholder or somebody else, it's difficult for any industry or any entity within an industry to be sustainable, or at least self-sustainable. And a self-sustaining business model is exactly what football needs. Financial fair play is based on concepts of accounting, and anybody who knows about concepts of accounting understands that they can be potentially manipulated, be misunderstood, and error-prone. Accounting is subject to independent audit based on the requirements for international standards for auditing that could be localized into a specific jurisdiction, but that's where the audit stops. It doesn't extend towards financial fair play submissions. So if the government, via its regulator, or if English football was looking to improve their financial sustainability, one simple way could be to focus on cash rather than accounting. It's a simplified version of accounting and could be a simple way to measure compliance with sets of finance rules that takes away the complexities of accounting. Some key questions that we need to answer in the football industry is why the football clubs exist. And at present, we have huge investment in English football from local and foreign investors. And these investors have put their own money into football clubs, some of which may have done it just for fun, as a hobby, a very expensive one at that, but some will be doing it genuinely to make money. And it's difficult to make money from football clubs for a whole variety of reasons, especially when it comes to extracting value from a trading entity that's historically made losses. So what football could do is maintain or mandate a certain specific minimum level of reserves. A simple solution. But how could clubs get there if they're in a historical loss-making position with no distributable reserves and brought forward losses? To draw a line under those historical losses, football as an industry, its governing bodies, or potentially the regulator could request an equity injection that couldn't be reduced in future. A capital contribution to wipe out any historical losses. And that would only be needed in the case where the equity position was negative. It might already be the case that equity has been injected by shareholders to cover existing losses, at which case, that's fine. A capital reduction could be performed, with certain guarantees being put in place by directors and shareholders to ensure the future of the club and to prevent the club being wound up. Certain rules, specifically UEFA rules, prevent this from happening at present, and it could be a simple fix. But the risk of creating distributable reserves could be that shareholders look to extract funds from the club. Again, coming back to the question, why do clubs exist? Are they there to create profit for their shareholders? And given the level of personal wealth that's gone into the English game so far, I think we're way beyond restricting the ability to extract funds or generate a profit either through trading or through sale at this point in time. When we talk about investment, what do we mean? By definition, an investment is the acquisition of an asset for the purpose of generating income or an appreciation in the value of the asset. When we talk about investment in a football context, we generally refer to spending money on players, acquiring more talent, paying transfer fees, paying more wages and agent fees. From a football club's perspective, a player registration is an asset, with its wages being an expense. But what a club is investing in is its future on-pitch performance, which could lead to future revenues. Hence, the ability to treat the cost of acquisition of a football player registration as an asset to begin with. From an accounting perspective, investment in players can lead to making losses for football clubs. And that's generally because the cost recorded in the profit and loss account outweighs the revenue that's generated. However, the rules at present request that losses, or at least cash losses, in UEFA and the Premier League are underwritten by the shareholders. On the whole, it's very difficult for clubs to be able to pay dividends to its shareholders. And therefore, the only way that shareholders can extract value from clubs is by holding the asset for a longer period of time and then making value from the sale of that asset. Very much like a private equity model that looks to invest in an entity, turn its trading performance around and flip it on at a profit at a future point in time. Private equity models tend to last between 3 and 5 years, whereas some football clubs are held for even longer than that. And with recent valuations on the back of the Chelsea sale, with Manchester United potentially being worth 4, 5, 6 billion pounds, according to the Glazers at least, that's a significant return on the investment of around about 700 million, with funds being extracted in the form of dividends and in interest. Manchester United may be an extreme example, but it's a good one for us to be able to understand what the potential or growth is within the football industry. And nobody could argue that a sales price of anywhere between 4 and 6 million pounds would be a fantastic return on investment. Therefore, from the owner's perspective, it's very much a worthwhile exercise. However, football fans may disagree with the way that the club is being treated. And this continuous balancing act of business success versus on-pitch performance, or even shareholder success versus on-pitch performance, is a careful balancing act that is very difficult to achieve success across the fan base. Each fan will have its own view on that particular topic. When it comes to systemic stability, the second primary objective of the independent regulator, this is looking to protect the whole of the football pyramid by trying to ensure that one failure in a specific club does not have a knock-on impact throughout the various leagues. One club could be a creditor of multiple others, and a failure in one club could have a knock-on impact throughout the league, or even leagues beyond the one that the original club is playing in. And clubs at the top of the pyramid get the lion's share of any broadcasting deals, which is another issue that the regulator is looking to address. Financial distributions, according to the regulator, need to be more evenly distributed across the football pyramid. The regulator will have the power to sort this issue out. However, it's looking for football to find a solution of its own, for the Premier League and the EFL to agree a deal, one which both parties are happy with. And if this deal cannot be reached, the regulator will hold the powers to mediate between the two. But this will only be as a final resort. Let's assume that a deal can be made either by football or forced through by the independent regulator. The challenge that the regulator is going to have, or that the leagues are going to have, is how are those funds going to be restricted when it comes to spending? History says that clubs that generate more funds, or that are given more funds in the form of parachute payments, tend to spend that money. And that money goes directly on players through transfer fees, agent fees, and salaries. This is with a view to try to improve football performance and get back up the league structure. So the first two objectives are very much focused on finances. But what about the third primary objective, around cultural heritage? This is less of a financial issue. However, club heritage items such as the club name, the badge, and the home colours will be protected by the regulator. The one element of financial consideration is with a view to controlling or approving the sale of a club's stadium. Lower league clubs have used the sale of a stadium to try to circumvent FFP rules in the EFL, and that's led to the profit on sale of stadiums in the EFL being excluded from that calculation. But this issue goes beyond FFP. Clubs that are separated from their stadia tend to jeopardise their own future. It's very difficult once they've been separated to get them back together. Control of the stadium asset may be separate to control of the football club. If it was done to generate a profit at arm's length to an independent party, then it puts the club at risk of losing the use of that asset altogether. The three secondary purposes of the regulator include domestic competitiveness, international competitiveness, and investment. When considering its regulatory duties, the independent regulator will look at its impact on the domestic competition, creating sporting balance across the whole pyramid, or assessing whether its actions or inactions could affect that domestic product. It will also consider international competitiveness, encouraging homegrown talent, and attracting talent into English football, which is something that the Premier League in particular has been very good at. The third element being investment, which is something again that the Premier League has been able to attract both from the UK environment and abroad, particularly from US investors and more recently Middle Eastern investors. And the investment into the Premier League in particular is something that's allowed the Premier League to become one of the most competitive football or sports leagues in the world. And with that comes an increase in its financial value. And one way or another, the Premier League or its clubs will pay tax to the UK government. So it's definitely something that the regulator is not going to want to interfere with. How will the regulator be funded? And what will the impact be to clubs? Well, quite simply, the regulator will be funded by the clubs that it's going to govern. A levy will be placed on clubs proportionate to revenue, which means that bigger clubs that generate more revenue will pay a higher levy. And the regulator believes that this is the right approach, with the larger clubs essentially paying for the protection of the whole football pyramid, at least proportionately. There will be an additional cost of compliance to clubs. And the idea is that the regulator will have a licensing system similar to that of UEFA. And these licensing systems require a lot of information provision from the club to the governing body. In this case, it will be the regulator. As part of these licensing conditions, the regulator will use 4 threshold conditions. These will be financial resources, suitable owners, fan interests, and approved competitions. Looking primarily at financial resources, clubs will be required to report forecasts to the regulator. And our view is that that forecast should be primarily focused on cash, because a club will not be able to sustain itself without those cash resources. Looking at this from an accounting perspective gives you a specific view, but it's the cash resources that will ultimately be required. An increased level of scrutiny will be given to the owners and directors tests, with further detail above and beyond the tests of the Premier League or the EFL. And the tests would consist of 3 key elements. The first essentially being a fitness test of the owners and directors. The second being around an enhanced test of owners' wealth. Where did that wealth come from to begin with? And the third being a requirement of financial plans to be put in place that are robust. An annual statement of compliance will be needed to be submitted to the regulator, meaning that retests could happen in the future. The regulator will call for an improved set of corporate governance structures across English football. What does this mean? A new football club governance code is going to be introduced, which will see an enhanced requirement around the corporate governance structure in football clubs. The creation of this code will leverage existing governance codes, such as the Code for Sports Governance, or the UK Corporate Governance Code. But what does corporate governance mean, and how will it be applied in practice? Well, first of all, the organisations, being the football clubs, will need a clear structure of governance, clear reporting lines, clear accountability, who is responsible for which area of the business, how much can be spent by those individuals, who controls the budgets, who controls the cash flows, who's going to make those difficult decisions if the cash isn't there, and who is going to be ultimately responsible if things go wrong. Underpinning that corporate governance structure is having the right people with the right skills in place. And this presents an opportunity for football to recruit better people into more senior positions. People who have experience in business, running complex businesses, potentially in a regulatory environment, whose experience could be leveraged to benefit football as an industry. We strongly believe that education will form a key part of that people structure, making sure that people have the relevant skills in those right roles. And it's likely that non-executive directors will be a requirement in the Football Club Corporate Governance Code. Independent non-executive directors will provide scrutiny across the club, including financial matters, legal matters, and potentially even recruitment matters. Communication internally and externally is a key part of any corporate governance structure, ensuring that staff on the ground understand their role as part of the overall structure, as well as disseminating information to stakeholders beyond the 4 walls of the football club. Fans, for example, investors, banks, suppliers, other customers, be it corporate customers or people on the other side of the world buying some form of fan token, for example. This improvement in corporate governance presents opportunities to people who want to work in the football industry. The future of football is going to be tightly governed, and people who have worked in regulatory environments are going to be in a prime position to secure roles in football clubs, if desired. Join us next week for part 2 of our video that reviews the independent regulator across English football, where we'll make suggestions of how football as an industry can improve itself, or even how the regulator can enforce that improvement. We'll also look in further depth at the financial distributions. We'll also answer the question about what guarantees the regulator can put in place around the future of football clubs and around breakaway leagues, as well as looking at the regulator in practice and any sanctions it has. So join us next week. And remember, if you like the video, hit like and subscribe for more videos on the topic of football finance. My name is Neil Wood and I'm a football finance professional.